Over $2.1 billion worth of Bitcoin and Ethereum has just been dumped across multiple exchanges in under 36 hours. Whale wallets are moving fast, institutional wallets are going cold, and now rumors are flying that BlackRock is quietly pulling out of crypto, while Binance faces internal disruption. This is not just a correction, this might be the beginning of a full-scale crypto collapse. Stay with me, because the data you're about to see is not being shown anywhere else. Not yet. Between April 17th and April 19th, blockchain analytics detected over $2.1 billion in BTC, ETH, and USDT being withdrawn from centralized exchanges, primarily Binance, Coinbase, and OKX. According to data from Whale Alert and LookChain, a wallet linked to an institutional custodian withdrew 9,425 Bitcoin in a single transaction, worth approximately $600 million. Multiple ETH Whale addresses transferred 76,000 ETH, worth around $230 million, to cold storage or private wallets. Binance's BTC balance dropped 4.1% in just 48 hours. Coinbase Pro saw over 480 million USDT withdrawn to unknown wallets. This is not retail activity. Retail does not move $500 million in one sitting. This is strategic, organized, and eerily coordinated. And when big money starts moving out this fast, it means they know something we don't. Now here's where things get truly disturbing. On April 18th, a tweet from a verified crypto analyst at the macro Whale sent shockwaves through Twitter. BlackRock has paused all new BTC ETF inflows across 3 custodians. Confirmed. No media coverage yet. That tweet alone triggered over 6 million impressions in under 4 hours. What followed was even worse. Google Trends showed a 300% spike in searches for BlackRock crypto exit. On-chain data indicated 0 new inflow into BlackRock's ETF addresses for 24 hours. Bloomberg analysts issued a warning that institutional ETF flows had dramatically stalled. Now let's be clear, there has been no official confirmation from BlackRock. But here's the problem. The silence itself is loud. If BlackRock has truly halted inflows, it would signal that the largest financial institution in the world is no longer confident in short-term crypto upside. And if they're stepping back, even temporarily, it opens the floodgates for panic. While BlackRock is going quiet, Binance is starting to crack. Internal sources from Cointelegraph and DL News suggest Binance has been facing back-end withdrawal delays, unusually high stablecoin outflows, and even employee restructuring in their European division. Just yesterday, Binance's USDT hot wallet saw its largest single-day withdrawal in 5 months. What's even more concerning, over 900 unique wallets split $870 million worth of BUSD and USDT into new addresses. These new addresses then funneled funds into private mixers, cold storage, and even newly created offshore wallets. Sounds like Binance whales and insiders are covering their tracks. And whenever that happens, it usually means one of 2 things. 1. Internal chaos is brewing. 2. Regulatory heat is coming. Remember what happened to FTX? The exact same withdrawal patterns occurred right before the collapse. Some analysts are still optimistic. They call this a healthy shakeout, saying whales are simply rebalancing, preparing for the next leg up. But let's take a hard look at the data. Bitcoin. Long positions currently make up 78% of all open interest across major exchanges. Over $400 million in liquidations occurred in under 12 hours, mostly longs. ETH funding rates have flipped negative on 5 out of 8 major platforms. DeFi TVL has dropped $1.6 billion in just 48 hours. This isn't normal. This is a systemic bleed. And the worst part? Retail investors are the last to find out. By the time you realize it's a trap, the whales have already taken profits, and you're left holding the bag. And this is just the beginning. Ethereum is bleeding, and no one's talking about it loud enough. While headlines are focused on Bitcoin's volatility, the real breakdown is happening underneath. DeFi protocols are quietly imploding, NFT markets are evaporating, and Layer 2 networks are draining liquidity at record speed. Let's begin with the numbers, because numbers don't lie. In just 72 hours, Ethereum's total value locked across all DeFi protocols dropped from $61.2 billion to $57.4 billion. Over $1.9 billion was withdrawn from Aave, Lido, Curve, and Uniswap. MakerDAO reported record low DAI minting, a sign that trust in decentralized lending is deteriorating. Lido's staked ETH saw a net outflow of 142,000 ETH, equivalent to over 400 million. Curve's volume collapsed 43% week over week, and Uniswap, the protocol processed 26% fewer trades, despite ETH gas fees dropping to near historic lows. This isn't a slowdown, it's a confidence collapse. And the worst part? No one is defending the price. Retail users are gone, yield farmers are running. And whales? They're dumping governance tokens, quietly, while Twitter argues over meme coins. Now look at NFTs. Yes, the hype died long ago, but the collapse is still accelerating. OpenSea volume just dropped below March 2021 levels. Blur's user base shrank by 34% in the past 2 weeks, and the average floor price of blue-chip NFTs like Azuki, CloneX, and Doodles down over 70% since January, with no signs of recovery. The NFT narrative, art, culture, digital ownership, has turned into exit liquidity for insiders. And it gets worse. Ethereum Layer 2s, once seen as the savior of scalability, are now facing liquidity starvation. Arbitrum's TVL dropped by $400 million in 5 days. Optimism's bridged ETH fell by 22%. Base, the Coinbase-backed L2, lost 18% of active users in a week. Even ZK Sync Era, the once hyped zero-knowledge network, is facing user fatigue. Its DEX volume shrank 44% in April. The problem? People aren't bridging in anymore. And those who did? They're bridging out. This is a red flag. Because when Ethereum's ecosystem starts leaking capital at multiple layers, DeFi, NFTs, L2s, it's not just a correction, it's a structural unraveling. And here's the part that no one dares to say out loud. What if this entire dump wasn't organic? What if it was engineered? Think about it. In just 1 week, institutional wallets moved billions. BlackRock ETF rumors spiked. Binance saw record withdrawals. Ethereum's foundation began crumbling, and sentiment shifted from bullish to fear. In under 48 hours, too fast, too clean, too perfectly timed. This isn't retail panic. It's a precision attack, a coordinated reset, designed by those who hold both the assets and the narrative. Now let's ask a dangerous question. Who benefits most from this collapse? Is it retail? Number, is it the developers? Number, is it the protocols? Also number, the ones who benefit. Are the ones who are not in the system right now, but want to re-enter cheaper. Hedge funds, BlackRock, whales who sold at the top, governments watching from a distance, regulators waiting to strike when the industry is weakest. The strategy is simple. 1. Trigger a controlled panic. 2. Let the system bleed. 3. Enter at a discount. 4. Then push the narrative of recovery with their fingerprints all over it. And guess what? It's already happening. Early data from CryptoQuant and Glassnode shows that new wallets are buying, not old ones. And some of the same institutional addresses that dumped BTC and ETH last week are now accumulating USDC and DAI on-chain. Waiting for re-entry. Let me repeat that. The ones who dumped are the same ones preparing to buy again, at your expense. This is the crypto equivalent of a controlled demolition. They knock it down. You scream. They buy it back. quietly, while you wait for confirmation. So now you're wondering, what should I do? Do I sell? Do I hold? Do I buy the dip? I'll give you one answer, and it's not financial advice. Don't do what they want you to do. They want you to panic sell. They want you to over-leverage and get liquidated. They want you to walk away just before the recovery begins, without you. So don't. Watch, wait, and prepare. Because part 3 of this story is even darker. We're going to expose the next trigger, the one that could lead to total collapse or total reset. And more importantly, we'll reveal what insiders are betting on, while retail investors are left in the dark. Stay with me. This isn't over. It's just getting started. Let's talk about what comes next. Because while the charts bleed and the influencers go silent, the real game is moving into its final phase. Welcome to the stablecoin war, the battle that could decide the future of the entire crypto ecosystem. And it starts with trust. USDT, Tether, still dominates over 65% of all stablecoin market cap. But recent on-chain activity shows something unusual. Over 700 million USDT has been swapped to USDC in just the last 48 hours. Large wallets are diversifying away from Tether, a pattern not seen since the Luna crash. Binance, which used to auto-convert all deposits to USDT, now shows direct USDC reserves increasing faster. Why? Because trust in Tether's backing is fading. Again. Multiple independent researchers have resurfaced concerns over Tether's reserves, especially with Chinese commercial paper and private loans backing billions in circulation. Meanwhile, Circle, the company behind USDC, has deep US banking ties and lobbying power. But don't get too comfortable, because USDC isn't safe either. In March last year, Circle lost access to $3.3 billion after the Silicon Valley Bank collapse. And even now, nearly 25% of its backing remains opaque, hidden behind regulatory disclosures. So here's the reality. Stablecoins, the one thing everyone in crypto relies on, might be the most vulnerable piece on the board. And if trust breaks, liquidity dries up, swaps get frozen, exchanges halt trading. And that brings us to the next phase of the collapse. Centralized exchanges, the silent threat. You've already seen this before. FTX didn't collapse when BTC dropped. It collapsed when liquidity stopped and withdrawals froze. Now look at current conditions. Binance is processing withdrawals slower than usual. OKX halted withdrawals for 3 hours due to maintenance. KuCoin was hit with a $10 million fine for KYC violations, and insiders fear more to come. Coinbase is under SEC review again, and could face another round of enforcement actions. Here's what's even more terrifying. Exchanges are not required to notify users before freezing access. The fine print in every terms of service agreement says it all. We reserve the right to suspend or terminate your access to services at any time, with or without notice. Translation: when the dominoes fall, you won't have time to react. And that leads us to the final question. What's the endgame? Where is this all heading? The answer is a new map of power. Because crypto is no longer a rebel technology. It's no longer about freedom or decentralization. It's being absorbed, repackaged, and rebuilt to serve a new master. Look at the signs. Governments launching CBDCs, exchanges partnering with regulators, Chainalysis tracking every wallet, BlackRock managing digital assets, AI scanning smart contracts in real time. What does this tell you? That the future of crypto might not belong to the people who built it. It belongs to the institutions who watched, waited, and are now buying in with full control. Decentralization was a dream. Now it's just a narrative, used to draw liquidity, then drain it. So what do? Do you give up? Do you rage quit? Do you go back to fiat and hope for the best? Number. Because this is not the end. This is a test of who truly understands the game. and who just played it for the hype. So here's what you need to do. Not financial advice, but survival logic. 1. Get your funds off centralized platforms. 2. Hold keys, not usernames. 3. Diversify between assets, chains, and stablecoins. 4. Watch for patterns, not headlines. 5. Most of all, ask who profits from your fear. Because every time there's a panic, someone is preparing to profit. And right now, while retail panics, the insiders are accumulating. They want your ETH, they want your BTC, they want your position. Cheap, desperate, vulnerable. Don't give it to them. We are at war, not with each other, but with the narrative that says we don't matter. You do matter. Your decisions matter. And if you choose to stay sharp, stay sovereign, and stay calm, you might not just survive this crash. You might come out stronger, freer, and more informed than ever. This channel will keep bringing you what the others won't. Raw data, real moves, unfiltered truth. Because this isn't just another bear market. This is a reset. And only those who know how to read between the lines will make it through to the other side. Subscribe, comment your thoughts, and stay tuned. Because what comes next will shock the entire market.